Something big just hit the DC housing market, and it's not getting enough attention. In just a few months, home listings in Washington, D.C. jumped by 47%. That's nearly half more homes on the market than usual. Why? A wave of federal layoffs tied to the Trump administration's cuts is forcing thousands of government workers to sell their homes. For years, federal jobs in D.C. were seen as rock solid, steady pay, great benefits, and job security. But now, whole departments are shrinking or disappearing, and the people who worked in those jobs, they're packing up, putting their homes on the market, and leaving behind a city that suddenly has too many homes for sale. This shift is already starting to affect prices, buyer demand, and long-term stability in some neighborhoods. If you're house hunting, this could be a rare opportunity. But if you own a home or just bought recently, you'll want to know what this means for your property value and what could come next. Stick with me, because in the next few minutes, we're going to break down what's really happening and what you can do about it. Quick question before we dive deeper. Do you think the DC housing market is about to crash, or is this just a temporary reset? Let me know what you think in the comments right now. If you live in the DC area, or you're thinking about buying or investing here, this next part is huge. Over the past few months, several federal agencies have started laying off workers as part of the Trump administration's push to reduce government spending. Thousands of government employees have already lost their jobs, and more cuts are on the way. Now think about this. DC is a city that runs on federal jobs. Those workers are also homeowners, renters, and consumers. When they lose income, they don't just leave their jobs. They often have to leave the city. And that's exactly what's happening. People who never planned to sell are suddenly listing their homes. In fact, real estate analysts say DC hasn't seen this many homes on the market at once since the 2008 housing crisis. And it's not just one neighborhood, it's everywhere, from Capitol Hill to Silver Spring. But it's not just about numbers, it's about the ripple effect. Home values could start dropping if supply keeps rising. Sellers are facing longer wait times and lower offers. Buyers are wondering if they should jump in or hold off for even better deals. Renters might see some relief too, with more people trying to rent out homes they can't sell. And here's the tricky part. This isn't a short-term issue. If federal layoffs continue, DC real estate market could take months or even years to stabilize. This matters to you because whether you're renting, owning, or investing, your financial future is tied to the health of your local market. You need to understand what's happening now to make smart decisions later. So let's dig deeper into the numbers and trends and figure out where this market is headed next. So what does a 47% spike in home inventory actually look like? Let's start with the numbers. In a normal year, DC would expect about 6,000 active listings during peak season. But as of this spring, that number shot past 8,800, an increase we haven't seen since the aftermath of the Great Recession. Real estate platforms like Redfin and Zillow are all reporting the same trend. Inventory is climbing across almost every neighborhood in the DC area. This surge has a clear cause. Thousands of federal employees were laid off or nudged into early retirement packages. Agencies like the Department of Education, the Environmental Protection Agency, and sections of the IRS have seen major staffing cuts. That means a huge group of middle-income and upper-middle-class homeowners, people with mortgages, kids in school, and financial plans that depended on steady government paychecks, are suddenly being forced to sell their homes. Neighborhoods that were once known for their stability are now feeling the pressure. Capitol Hill, home to many mid-career government workers, has seen a noticeable spike in listings. Over in Petworth and Brooklyn, areas popular with families and young professionals, sellers are dropping prices just to stay competitive. Even across the river in Alexandria and Arlington, inventory is climbing fast, especially among townhomes and starter homes that once sold easily. In many cases, homes are sitting on the market 30 to 40% longer than they did just a year ago. Sellers who expected multiple offers are now slashing asking prices by $25,000 or more to spark interest. Buyer behavior has shifted dramatically too. With so many more homes available, buyers aren't rushing to submit offers above asking anymore. They're slowing down, negotiating harder, asking for seller concessions, and even walking away if they don't get exactly what they want. But even even with more inventory and more negotiating power, many buyers are nervous. They're wondering if this is the beginning of a larger housing crash, whether it makes sense to wait 6 more months for even better deals, and what happens if mortgage rates stay high. It's a strange market dynamic. On the one hand, buyers have more control than they've had in years, but on the other, uncertainty is freezing a lot of people in place. Economists call this a liquidity freeze, when there's plenty of supply, but not enough confident demand to keep the market moving. Looking back at history gives us some clues. After the 2008 financial crisis, DC experienced a slow but steady rise in inventory and a gradual dip in home values. It took years for buyer confidence to return. But today's market has one major difference: interest rates. Unlike 2009, mortgage rates are much higher today, meaning even if prices fall, monthly payments don't get significantly cheaper. For example, a $600,000 home today could have the same monthly payment as a $500,000 home did just 2 years ago. That reality is keeping many first-time buyers cautious, and it's pushing some people to stay in rentals longer than they originally planned. The bottom line is simple. This isn't a blip. It's not just a cooling off period. It's a structural shift in DC's housing market, driven by jobs, policy, and real fear. And how you respond, whether you buy, sell, or wait, could have serious long-term impacts on your financial future. Now, I want to hear from you again. If you were buying right now, would you negotiate hard or wait 6 more months for prices to fall? Drop your answer in the comments. I'm curious how you would play it. Let's talk strategy, because this isn't business as usual. If you're buying a home right now, you finally have power in your corner. There's more inventory than we've seen in years, which means more choices and far less pressure. Sellers are open to negotiating, and many are even offering perks like closing cost assistance or mortgage rate buy-downs just to secure a deal. That said, interest rates remain high, so your monthly mortgage might not feel like much of a bargain, even if the sticker price is lower. That's why it's crucial to run the math, use a mortgage calculator, and make sure your monthly payments actually fit your budget. Take your time. There's no rush anymore. This is the kind of market where you can pause, compare, and think long term. If you plan to stay in the home for 5 years or more, short-term price swings probably won't hurt you. For sellers, the market has changed dramatically. Gone are the days of bidding wars and multiple offers in a weekend. Now, it's all about standing out. Sellers need to be smart with pricing, basing their strategy on recent sales, not just hopeful listing prices. Homes that sit too long start to look stale, and buyers become wary. Presentation matters more than ever. Clean, stage, and photograph your home properly to get attention. Flexibility is key. You may need to accept lower offers, cover closing costs, or agree to contingencies if you want to seal the deal. Investors are walking a fine line between opportunity and risk. Yes, there are discounted properties and sellers under pressure, but rental demand could shift too, especially if job losses force more people to leave the area or delay relocation. For investors, it's all about the numbers. Focus on properties that offer positive cash flow from day one. Don't rely on future appreciation. Pay close attention to which neighborhoods are more likely to bounce back quickly, especially those tied to job hubs or transit. And make sure you have reserves. If prices dip further or tenants move out unexpectedly, you'll need that cushion to ride out the volatility. No matter where you stand, buyer, seller, or investor, the bottom line is the same. Don't just react. Plan ahead. Understand the market, and move with intention. Washington, D.C.'s housing market is going through a major shift, and it's happening fast. A 47% surge in inventory isn't just a number. It's a sign that economic forces, like federal layoffs, can ripple out and reshape entire cities. Homeowners are adjusting, buyers are cautious, and investors are watching closely. But here's the real question. What will you do with this information? If you're thinking about buying, this might be your first real shot at negotiating power in years. If you're selling, now's the time to rethink your pricing strategy and prepare for a longer timeline. And if you're investing, the right property in the right location could still be a smart move, but only if the numbers make sense. Markets like this don't last forever. They shift, they settle, and eventually they rebound. So, do you think DC's housing market will bounce back, or are we looking at a long decline? Drop your thoughts in the comments. Let's hear what you're seeing on the ground. And if you want to know more about this subject, like and subscribe to keep updated.